For decades, wars were won with tanks, missiles, and soldiers. And then came sanctions, quiet, invisible weapons designed to suffocate economies instead of cities, cut a nation off from banks, freeze its reserves, isolate it from global finance, and eventually, the theory went, it would surrender without a shot fired. But what if that weapon no longer works? What if money itself has slipped beyond borders, beyond governance, beyond sanctions? Today, wars are no longer fought only on land, sea, air, or even cyberspace, but inside blockchains, wallets, and lines of code, a place where no central authority exists, where financial power moves at the speed of the internet, where enemies can raise funds, move value, and survive economic sieges without ever touching a bank. This is the digital battlefield. And the uncomfortable truth is this: crypto didn't just disrupt finance, it disrupted the entire idea of economic warfare. The mystery we're unraveling today is not whether crypto is being used in global conflicts. It's whether sanctions, one of the most powerful tools in modern geopolitics, are quietly becoming obsolete. To understand why this matters, we need to step back into a world that no longer exists. For most of modern history, money flowed through choke points, banks, clearinghouses, central banks, payment networks like SWIFT. These weren't just financial institutions, they were instruments of power. Whoever controlled them could decide who participated in the global economy and who was cast out. After World War II, this system became the backbone of global order. The US dollar sat at the center. International trade settled in it. Energy was priced in it. Foreign reserves were held in it. And sanctions became the scalpel of modern warfare. Instead of invading a country, you froze its assets. Instead of bombing factories, you blocked imports. Instead of toppling regimes with armies, you starved them of liquidity. Iran, North Korea, Venezuela, Russia, different politics, same weapon. Sanctions worked not because they were violent but because they were unavoidable. Until suddenly, they weren't. In 2008, while governments were bailing out banks and rewriting financial rules overnight, a 9-page white paper appeared online. Its author was anonymous. Its timing was suspicious. Its message was radical. Bitcoin proposed a system where trust was replaced by math, and authority by consensus. No central bank, no permission, no borders. At first it looked like a nerd experiment. Then it became money. And without intending to, it introduced something far more dangerous to the existing order. Sanctions resistance by design. Crypto didn't care who you were. Crypto didn't ask where you lived. Crypto didn't freeze accounts. Crypto didn't obey governments. And slowly, almost invisibly, it began to attract attention from the very actors sanctions were meant to control. The first adopters weren't hedge funds or Wall Street banks. They were outsiders, blacklisted regimes, isolated economies, groups locked out of international finance. North Korea's cyber units reportedly shifted from hacking banks to hacking exchanges. Iran began exploring crypto mining not as innovation, but as a way to turn sanctioned energy into uncensorable value. Venezuela experimented with state-backed tokens when its access to dollars collapsed. At the time, Western policymakers laughed it off. Crypto was too small, too volatile, too niche. That assumption wouldn't age well. As crypto infrastructure matured, so did its utility in war zones. Wallets became easier to use. Exchanges multiplied. Stablecoins reduced volatility. Peer-to-peer networks bypassed intermediaries. And something remarkable happened. Money began moving where sanctions said it couldn't. When traditional aid routes collapsed, crypto donations flowed directly to individuals. When banks shut accounts, wallets replaced them. When borders closed, blockchains remained open. This wasn't theoretical. In conflict zones, crypto became emergency funding, capital flight protection, black market settlement, sanctions, evasion tool, psychological weapon. But here's the twist most people miss. Crypto didn't just help sanctioned actors. It helped everyone inside the blast radius of sanctions. Civilians, NGOs, refugees, dissidents. Sanctions were blunt instruments. Crypto was precise. And that created a moral contradiction governments weren't ready for. The real breaking moment didn't come quietly. It arrived with a global shock that forced every financial authority to pay attention. A major geopolitical conflict, unprecedented sanctions, central bank reserves frozen overnight, banks cut off at scale. Suddenly, billions, sometimes hundreds of billions were trapped. And in the background, something unprecedented happened. Crypto volumes surged, stablecoin usage exploded, Wallet activity spiked in sanctioned regions. For the first time, policymakers had to confront a terrifying question. What happens when sanctions push financial activity into systems they can't control? The answer wasn't reassuring. Governments reacted the only way they knew how. They pressured exchanges. They regulated on-ramps. They blacklisted wallets. They demanded compliance. But crypto wasn't a single enemy. It was an ecosystem. Shut down one exchange, another appeared. Freeze one wallet, value moved to 10 others. Ban mining here, it relocated there. This wasn't a loophole, it was structural. And as enforcement tightened, innovation accelerated. Privacy coins, mixers, decentralized exchanges, layer 2 networks, cross-chain bridges, each designed to solve one problem. How do you move value when the world doesn't want you to? By this point, sanctions had created something paradoxical. The more aggressively they were enforced, the more attractive crypto became. What was once a fringe technology had turned into a financial survival tool. What was once dismissed as speculation had become geopolitical infrastructure. And the most dangerous part, there was no going back. Because once money learns how to escape control, it never forgets. Sanctions were never designed for a world without gatekeepers. They assumed money had choke points, banks to regulate, wires to block, institutions to pressure. But crypto erased the most important assumption of all, that economic power could be centralized. The breaking point arrived quietly, buried in transaction data rather than headlines. As sanctions expanded in scale and severity, something unexpected showed up in blockchain analytics: financial adaptation, not collapse. Wallet creation surged in sanctioned regions. Peer-to-peer trading volumes spiked where banks disappeared. Stablecoins, digital tokens pegged to fiat currencies, became lifelines, not investments. Sanctions were supposed to isolate economies. Instead, they rerouted them. This wasn't defiance. It was survival. And that's what made it dangerous. Every sanction triggered a reaction. Banks froze accounts, gives wallets replaced them, currency collapsed, gives stablecoins absorb demand. Capital controls tightened, gives decentralized exchanges expanded. Cross-border payments failed, gives blockchain settlements continued. Each policy created the very behavior it tried to prevent. Because when people lose access to financial infrastructure, they don't stop transacting. They just stop using official channels. And crypto offered something no sanctioned system ever had: continuity. No holidays. No shutdowns. No approvals. Value moved 24/7, borderless and persistent. Governments weren't just losing leverage, they were losing visibility. This is where the story turns uncomfortable. Sanctions were meant to weaken adversaries while protecting civilians. But crypto blurred that line. When entire banking systems were cut off, it wasn't just governments that suffered. Ordinary people lost savings, salaries, and access to necessities. NGOs couldn't move funds. Aid organizations faced delays. Refugees were trapped with worthless cash. Crypto filled the gap. But by doing so, it also shielded sanctioned actors. The same networks that helped civilians survive also helped states adapt. The same wallets that received humanitarian aid also moved strategic funds. The same decentralized rails carried both relief and resistance. This wasn't a failure of ethics. It was a failure of design. Sanctions weren't built for dual-use financial systems. What made policymakers nervous wasn't ideology, it was numbers. Blockchain data revealed patterns that contradicted decades of economic warfare theory. Transaction volumes rebounded faster than expected. Informal crypto markets replaced formal trade routes. Financial isolation timelines shortened dramatically. Enforcement costs skyrocketed, while effectiveness declined. The digital battlefield didn't eliminate sanctions. It reduced their half-life. Pressure still worked, but only temporarily. And each cycle of enforcement trained markets to adapt faster next time. Sanctions became less like sieges, and more like stress tests. Governments tried to regain control. They regulated exchanges. They demanded KYC, they tracked wallets, they partnered with blockchain analytics firms, and for a moment, it looked like it might work. But crypto wasn't centralized enough to contain. Every regulatory success pushed activity toward decentralized alternatives. Every enforcement action strengthened privacy tools. Every crackdown taught users how to move more quietly. This created an arms race no one officially acknowledged. On one side, states regulators, financial intelligence units on the other, developers open source protocols, permissionless networks. And unlike traditional warfare, this battlefield had no surrender point. You can't sanction math. You can't embargo code. You can't arrest a protocol. Once you see it, you can't unsee it. Every modern conflict now follows the same financial pattern. 1. Crisis erupts. 2. Sanctions escalate. 3. Traditional finance collapses locally. 4. Crypto adoption spikes. 5. Enforcement tightens. 6. New crypto pathways emerge. It's a loop, and each time, the digital infrastructure becomes stronger, faster, more resilient. This isn't about crypto winning, it's about control eroding. Economic warfare once relied on dominance over money flows. But money has learned how to route around damage, just like the internet did with censorship. Here's the part rarely said out loud. If sanctions lose effectiveness, global power structures shift. Financial dominance has always been geopolitical leverage. Whoever controls settlement systems controls behavior. Crypto doesn't replace that power, but it fragments it. Instead of one global financial system, multiple parallel ones emerge. Instead of compliance, optionality. Instead of enforcement, trade-offs. This doesn't mean chaos. It means a weaker grip. And weaker grips don't enforce order, they negotiate it. 3 clear takeaways. Takeaway number 1. Sanctions are no longer absolute. They still hurt, but they no longer suffocate. Crypto introduces escape velocity. Takeaway number 2. Economic warfare now has collateral innovation. Every restriction accelerates alternatives. Pressure doesn't freeze systems, it reshapes them. Takeaway number 3. The digital battlefield is permanent. Crypto isn't a phase of conflict. It's now part of the terrain. The real danger isn't crypto. It's pretending the old rules still apply. Because if governments keep designing sanctions for a centralized financial world that no longer exists, they may find themselves enforcing power that looks strong but isn't. The next global conflict won't ask whether crypto should be involved. It will assume it already is. And the only unanswered question is this: will economic warfare evolve, or quietly fail? If this video changed how you see sanctions, money, or modern conflict, let me know in the comments. If you want deeper breakdowns of financial warfare, hidden economic history, and how money shapes global power, consider subscribing. Because in the digital battlefield, understanding the system isn't optional anymore. It's survival.